feel like most people pick a prop firm in the same way they pick a Netflix show. They just grab whatever's trending. Welcome to episode 9 of the Joinprop podcast.
Oh, wait, your audio
Let's
is
see.
clipping?
Yeah.
Testing. Okay, I think we're good now.
Yeah, you're good.
Okay, sweet. So I'm the head of content here, and man, we just have a ridiculous amount of ground to cover today.
And I'm basically the outsider looking in. Like, I have a finance background, I follow the markets, but I am definitely not a funded trader yet.
Yeah.
So I'm here to essentially translate the trading brain for you guys listening.
Which is much needed, honestly.
Right, because I'm late 20s, I'm super curious about the space, I track the industry, but I haven't actually pulled the trigger on a challenge. So my whole job today is to just ask the embarrassing questions and call out when things sound completely unhinged.
Which, fair warning, is going to happen a lot today. Because look, the whole mission for today's deep dive is unpacking exactly why traders blow their evaluations.
And it's a lot of them. It's insane. And the thing is, if you go on Reddit or Twitter or whatever, people always think it's their strategy. They think, oh, my MACD crossover failed me, or my support and resistance lines were drawn wrong.
Right, they blame the chart.
Exactly. They think they just suck at trading. But the actual data shows it's almost always rule compatibility.
Rule compatibility, not skill.
Right. It's not trading skill at all. They pick a firm that actively, mechanically works against them, and they don't even realize it until they hit a hard breach and the account is just locked. So if we just look at the baseline reality here, and this is the stat that usually makes people physically sick, 90 to 95% of traders fail evaluations because the firm they picked doesn't match how they actually trade.
90%.
Yeah.
90. I need a second.
Yeah, it's...
No, but wait. If someone has a proven track record,
Yeah.
like they have a live account, they know what they're doing, they have an actual edge in the market, how does a firm just snap them in half like that?
Yeah.
That implies the rules are designed to break strategies that otherwise work in the real world.
Well, yeah. I mean, honestly, that's the fundamental delusion of retail traders.
Delusion is a strong word.
It is, but it's true. They see an Instagram ad, right? They see a 100K challenge for, I don't know, $50, maybe $80, and they think, oh, it's just $80, I'll just adapt. I'll just trade tighter. I'll have my lot sizes to fit their rules.
Which sounds reasonable on paper.
On paper, sure. But, okay, wait, let me back up. If you have, say, 3 to 6 months of live data, or even just a really rigorous demo history, you have a style. You have muscle memory.
You have a rhythm.
Yeah, a rhythm. You have a psychological baseline of exactly how much pain you can take in a trade before you panic close it. And you can't just ignore your own historical data to save $20 on a challenge fee.
So you're saying they force a square peg into a round hole.
Exactly. If your strategy relies on risking 2% per trade and like letting a trade breathe through a 30-pip drawdown before it finally goes into profit, but you buy a challenge at a firm with a super tight 4% daily limit,
You're just dead.
you are literally suffocating your own edge. You're signing up for an evaluation that fundamentally outlaws your natural trading flow.
Hold on, outlaws is a strong word too.
Yeah.
I get restricting risk, but how does a firm's rules actually outlaw a style? Like, assuming I'm not doing something crazy, a buy order is still a buy order. They aren't telling you what specific setups to trade.
They kind of are, though, by omission, or just by their infrastructure.
Let's look at scalpers, for example,
Mhm.
because this is where the mismatch is just violently obvious.
Okay, and by scalpers, we're talking about people hunting for tiny price movements, right? Like, not necessarily algorithms, but humans manually executing trades really fast.
Right. Intraday, high frequency. A real scalper is in and out. They need ultra-low latency. We're talking execution speeds under 100 milliseconds.
Which is basically instant.
Right. And they need 0 minimum hold times because sometimes a trade is just invalid after 4 seconds.
Mm-hmm.
And they need a really flexible daily drawdown, usually around 5 or 6% because the whole nature of scalping is taking a ton of tiny paper cuts.
Like little stop-outs. Yeah, little stop-outs before catching the actual momentum burst. But here's the dirty secret that nobody talks about on Twitter. A lot of prop firms secretly despise scalpers.
Why, though? If I'm scalping and I'm profitable, I'm generating volume. Shouldn't a firm want a profitable trader, regardless of how fast they click the mouse?
Okay, to explain that, we actually have to talk about how the broker backend works, because a prop firm isn't a broker. They just white label a broker's feed. And we need to get into the difference between A-book and B-book models.
Oh, boy. Okay, lay it on me.
So an A-book broker takes your trade and routes it directly to a liquidity provider. a bank, essentially. The broker just makes money on the commission or the spread markup.
So they don't care if you win or lose.
Exactly. They don't care at all. They just want you to trade a massive amount of volume. But a huge percentage of the retail prop firm industry runs on a B-book model,
Meaning they keep the trades in-house.
meaning they warehouse the risk entirely. They are the market maker for your specific account. They literally take the opposite side of your trade. If you buy your USD, the firm is essentially selling it to you.
Wait, so if I win a trade, the firm loses that exact amount of money?
In a pure B-book model on a funded account, yes.
That is wild.
Now, during the evaluation phase, it's all demo money anyway, so it's just simulated. But if you get funded and they keep you on a B-book, your profit is their direct loss. And scalpers are what the industry calls toxic flow.
Toxic flow. That sounds incredibly insulting to the trader.
I mean, from a risk desk perspective, it is toxic. Scalping puts massive stress on the firm's infrastructure. Hundreds of micro trades during highly volatile, low liquidity market conditions. It costs the firm money and server load.
Right.
It creates massive slippage issues where the firm's price feed gets out of sync with the real market. And honestly, it's just incredibly hard for a firm to copy trade a fast scalper into the real live market if they wanted to offset the risk.
They're just losing money on them.
Usually, yeah. So instead of just banning scalpers outright and looking like the bad guys in their marketing, they implement rules specifically to filter them out passively.
Like what? What kind of rules?
They'll sneak in like a 30-second minimum hold time. Or they'll set a really strict daily drawdown of 3%, knowing a scalper will hit that on a normal Tuesday just through normal variance.
That feels like a scam.
It's not a scam.
I'm not saying illegal. I'm saying it feels like one. Because you're advertising, come trade with us, show us your skills. But the fine print is literally a trap door designed for a specific type of trader to fall through. If they know scalping breaks their B-book model, they should just say, no scalpers.
Well, but
No, think about it. If you sell me a ticket to a race, but you don't tell me my car isn't allowed until I'm already on the track and you've taken my entry fee, how is that not predatory?
like, I get why it feels gross. It does. But from the firm's perspective, it's purely risk management. They don't want someone bombarding their servers with a sub-millisecond bot that just exploits their feed latency.
But we aren't talking about bots right now. We're talking about a human being who just trades fast.
Sure, but the frame's automated software often can't tell the difference in real time between a human scalping a news spike and a toxic latency algorithm. So they just blanket ban the behavior.
That is so frustrating.
I agree. It's terrible for the honest trader who didn't read the FAQ page. You get a guy who trades the New York Open, right? He catches a massive momentum push, makes $1,000 in 15 seconds, closes the trade to secure the bag.
And he feels great.
He feels amazing. And then the next morning, he gets an email saying his account is terminated because he closed the trade at 28 seconds instead of the mandated 30 seconds. It is absolutely soul-crushing.
And he's just out the fee.
Gone. No refund.
Right.
Because technically, legally, he breached the terms of service he agreed to when he bought the challenge.
That is. Wow. Okay, so scalpers are essentially walking into a minefield unless they are meticulously checking the hold time rules.
Yeah.
What about the other side of the spectrum? People who hold trades for days. Because you always hear the debate between day trading and swing trading.
Yeah, so this is where the math gets genuinely fascinating. If we look at the data across major firms, swing traders, the people holding multi-day, lower frequency positions, they actually have an 83% higher success rate passing evaluations than intraday-only traders.
83%. That's, wait, almost double.
Yeah, it's a massive discrepancy, and it all comes down to how firms calculate risk and drawdowns. Because day traders, they get absolutely destroyed by trailing drawdowns. Okay, let me try to explain this clearly. Let's say a firm uses a trailing drawdown based on high watermark equity. If your unrealized P&L spikes up and then retraces during the session, your static hard stop is constantly moving up right behind you, anchoring to the peak. So your actual available breathing room is shrinking dynamically while you're in the trade, whereas a static drawdown just measures from the initial starting balance of the day, completely ignoring your floating.
Stop talking. You're losing me, and you're definitely losing everyone listening. Walk that entire thing back. High watermark, unrealized P&L dynamic breathing room. No. I need you to explain that, like, I am a normal human being who just wants to protect my capital.
Sorry. Yeah, my bad. I get way too into the weeds with the terminology.
Yeah.
Let's simplify it with actual real numbers. Let's say you buy a $100,000 challenge account.
Okay, I have 100 grand.
The firm gives you a maximum total drawdown of 10 grand, 10%. If it's a trailing drawdown, that 10 grand failure limit follows your highest account balance. It trails you. So you open a trade and it goes perfectly. You are up 5 grand in floating profit. You haven't closed the trade yet, but your screen says $105,000.
Feeling good. Buying a boat in my head.
Right. But your failure limit just moved up with it. It was at 90,000. Now it is anchored 10 grand below your new high. So your new failure line is $95,000.
Okay.
Then the market turns. News comes out, the trade drops. It completely erases your 5 grand profit and drops another $1,000 into the red. You panic and close the trade. Your account balance is now $99,000.
Which means I'm down 1% from my starting balance.
Yeah.
I still have 99 grand.
Yes. But remember, your failure line moved up to 95,000. You originally had 10 grand of breathing room. Now you only have 4 grand of breathing room.
Wait.
Even though you only lost $1,000 of your starting capital. If you take a few more trades and the account dips to 94,999, you fail the challenge, even though you technically only lost 5% of the original 100 grand, not 10.
Wait. So I could fail an evaluation without ever actually dipping below my initial stated starting balance limit. Like, the invisible line just creeps up and strangles me.
Exactly. The line strangles you. Day traders get killed by this because they take a lot of trades. The market fluctuates. Their floating profit spikes and drops constantly throughout the day. And that trailing limit just acts like a ratchet, pulling tighter and tighter until they get choked out.
That is insidious.
It really is. But swing traders, on the other hand, they actively seek out and thrive in firms with static drawdowns.
Meaning the line doesn't move.
Right. It stays at 90,000, period. No matter how much your profit fluctuates during the week, if you go up to 105K and drop back to 100K, your failure line is still safely down at 90K.
Oh, wow.
Yeah, and swing traders use wider stop losses. They take maybe 1 or 2 trades a week so they aren't triggering these weird intraday mathematical traps. Plus, they specifically look for firms that don't ban holding trades overnight or over the weekend. Which, by the way, is a whole other restriction you have to double check.
Okay, so if the math is that stacked against day traders, if swing traders have an 83% higher pass rate, why doesn't everyone just become a swing trader? Like, if you're listening to this deep dive and you're looking at those odds, why would you ever open a 5-minute chart again?
Because you can't just flip a switch on your psychology. It doesn't work.
Right.
If you don't have the innate patience for it, you will force trades and fail anyway.
What do you mean force trades?
Like, honestly, think about the reality of swing trading. You enter a position on Monday, it goes against you for 36 hours, you're sitting in the red.
Just staring at a negative number.
Right. Then Thursday, it comes back to break even. Then Friday, it drops again. You have to sit on your hands and do absolutely nothing while watching your money fluctuate for an entire week.
Right.
It is psychological torture if your brain is wired for fast action and instant feedback.
Right, you'll start messing with the terminal. You'll start playing with buttons just because the screen isn't doing anything.
Yeah, exactly. You'll get bored. You'll look at a 1-minute chart. You'll convince yourself you see a setup. You'll revenge trade in the middle of a random Tuesday afternoon just to feel something, and you'll blow the account.
So it's a personality mismatch.
100%. You cannot fake being a swing trader.
Mm.
So the lesson isn't change who you are to fit the firm. It's find the firm that uses a static drawdown so you can trade your intraday style safely.
Which requires actually reading the rules.
It requires dissecting them. Which actually brings us to, well, probably the most universally hated rule in the entire industry, the news trading minefield.
Oh, I see people complaining about this on Twitter constantly. This is when the big economic reports come out, right? Like inflation numbers, jobs reports.
Yeah, CPI, non-farm payrolls, FOMC interest rate decisions, event-driven trading. When those numbers drop, the market goes absolutely insane for like 10 minutes. Huge algorithmic volume kicks in, price spikes 50 pips in a single second.
Right, I've seen those charts where it just looks like a massive vertical line.
Yeah, it's wild. And some retail traders build their entire strategy around this volatility. They play the breakouts. But if you're taking an evaluation for a prop firm, news trading blackouts are standard. Usually it's 2 to 5 minutes before and after major announcements.
So you just flat out cannot trade during that window.
You cannot execute new market orders, you cannot close existing orders, and crucially, you cannot have pending limit or stop orders triggered during that window. Depending on the firm, like Think Capital, QT Funded, Blue Guardian, they all have variations of this. If you clip that window, let's say a major CPI announcement is at 8:30 a.m. exactly. You enter a trade at 8.28 and 10 seconds. You are dead.
What do you mean dead? Like the platform just rejects the order.
No, I mean immediate hard disqualification of your entire account. You lose the evaluation with zero refund of your challenge fee.
Wait, that's literally their business model.
Well,
No, stop. Think about the implication of that. If someone is just a casual trader, or maybe they live in a different time zone, they're in Sydney or London, they forget to check the economic calendar one morning and they click buy 2 minutes before some obscure European banking report drops. They lose their entire $50 or $100 fee instantly, just for bad timing.
okay, to be fair to the risk desks at these firms, we have to look at the actual market mechanics of a news event. Trying to fill a retail order during CPI is an absolute nightmare.
Why? If the price is moving fast,
Uh-huh.
shouldn't it be easier to catch a trend?
Because liquidity just vanishes. When a major news event is about to drop, the big institutional market makers, the banks who actually provide the pricing, they pull their limit orders. They step aside entirely because they don't want to get run over by a surprise number. So the order book empties out. The bid-ask spread parts like the Red Sea. If you put in a stop loss at, say, 1.05 on zero, but the price gaps over it, the next available buyer might be way down at 1.0450.
So your stop loss doesn't even work.
It gets slipped massively. You might lose 5 times what you actually intended to lose. Now, remember the B-book model we talked about earlier?
Where the firm is taking the other side of your trade?
Right. If a prop trader uses huge leverage right before CPI and they get on the right side of the move, they might make 10% in 3 seconds. But because of the liquidity void, the prop firm couldn't possibly copy that trade to the real market, even if they wanted to. The firm's risk exposure during those 5 minutes is just astronomical.
Oh, because they'd have to pay the trader out of pocket.
Exactly. They would have to pay out massive phantom profits based on a feed that was lagging the real market. So because they can't guarantee execution, they just ban it outright to protect themselves.
Okay, I understand the technical risk.
Mm.
But defaulting to immediate account termination and keeping the fee, that is brutal. It feels like playing a game where the referee can just blow the whistle, claim you stepped out of bounds by an inch, and keep your registration money.
I mean, I won't argue with that. Challenge failure fees definitely keep the lights on for a lot of these companies. If you forget to check Forex Factory or whatever economic calendar you use in the morning, you are basically just donating your challenge fee to the firm's bottom line.
Which means the burden is 100% on the trader to essentially audit themselves every single morning.
Which is exactly why you have to know the math of your own strategy before you ever step on the field. You can't just be vaguely aware of these rules. And this is where people get really lazy. Because sitting down with a spreadsheet and analyzing rules isn't sexy. It's not fun. Looking at a chart and drawing trend lines is fun.
I mean, I hate math, so I completely sympathize with the laziness. But what kind of math are we actually talking about here? Like calculating lot sizes? Because calculators do that for you now online.
Sort of, but it's much deeper. It's about calculating your own historical equity curve margins against the firm's limits. I call it the 40-60 rule. And honestly, if you take absolutely nothing else away from this deep dive today, this is the core concept you need to burn into your brain for risk management. You have to set your own internal daily loss limit at 40 to 60% of the firm's stated limit, not right up against the wall.
Okay, that's abstract. Give me a highly specific, concrete example.
Okay, let's say you trade an index like NAS 100 and you buy a challenge where the firm clearly states you have a 5% daily loss limit. In your head, as a retail trader, you're thinking, cool, I can float a 5% loss today and I'm still perfectly in the game. I just can't hit 5.1%.
Right, that's what the rule literally says.
And that mindset is exactly why you will fail, because you are forgetting about buffer room. If you pull up your trading journal for the last 3 months and you see that your worst historical day, the deepest your account ever went into the red before recovering, was a 4.5% drawdown, you are mathematically guaranteed to fail that 5% challenge.
Because of normal market variance, like the slippage stuff we just talked about.
Exactly. Because a backtest or a clean demo account doesn't account for the actual friction of live trading. Let's break down a real NAS 100 trade. You're trading, say, 5 contracts. You enter right at the New York Open, which is super volatile. Your stop loss is set at exactly your 4.5% daily limit, but the second you enter the spread, the difference between the buy and sell price widens from 1.5 points to 4 points.
Because of the opening bell volume?
Right. And you also have to pay a commission, let's say $3 per side, per contract. So before the trade even moves a single tick, you are instantly in the hole for the spread and the commission. Then the price drops. It hits your stop loss. But because the market is moving so fast, your broker slips you by 2 points before they can execute the close.
Oh, so the math compounds against you.
It stacks. The spread widening, the commission fees, the 2 points of negative slippage. Suddenly, that trade that was supposed to max out at a 4.5% drawdown actually closed at a 5.01% drawdown.
And you're out.
And the firm's automated system instantly triggers a hard breach. Your account is locked. You are done. If you are operating at 4.5% on a 5% limit, you have zero margin for real-world error. You are suffocating your strategy. You need to be operating at half their limit to survive the invisible friction of the market. If their daily limit is 5%, your worst historical day needs to be 2.5%, maybe 3% maximum.
It's like trying to drive a massive semi-truck exactly 1 inch away from the concrete guardrail on the highway. Like, technically, mathematically, you fit in the lane. But the second a gust of wind blows or you hit a pothole, you're going over the cliff. You need a wider lane to absorb the bumps.
Yes, that is a perfect way to visualize it. You need a wider lane. And if your strategy naturally swerves a little bit, like you take bigger drawdowns, you let things breathe before hitting your profit targets, you cannot drive in a lane that's built for a compact car. You have to go out and actively find a firm that offers a 7% or 10% daily loss limit, or one that calculates drawdown based on balance instead of equity.
Which I'm guessing are way harder to find or significantly more expensive.
Not necessarily more expensive, but you really have to dig through the fine print for them, which honestly is the exact reason we ended up building the comparison filtering tools on Joinprop.
Yeah.
Because trying to cross-reference 50 different firm websites, reading through messy FAQ pages just to figure out their specific drawdown types and daily loss limits, it's impossible.
Yeah, nobody has time for that.
You just want to plug in, I need a static end-of-day drawdown with an 8% daily limit and see what actually exists.
Because otherwise you're just clicking blindly and hoping for the best.
Yeah. And speaking of clicking blindly, we haven't even touched the tech stack yet, the platforms and the algos, because even if you get your math perfect, the actual software you use can auto-fail you.
Oh, algorithms. Like the robots doing the trading for you?
Yeah.
EAs?
Yeah, expert advisors. And there is this huge, incredibly dangerous misconception on YouTube that you can just buy a bot online for $200, plug it into any prop firm's MetaTrader terminal, and just wake up funded a week later. But firms are in an absolute trench war with certain types of bots right now.
What is the firm's definition of a bad bot, though? If it makes money, why do they care?
Because of how they make money. They're looking specifically for high-frequency trading bots, HFT. These things are executing trades under 5 seconds, sometimes hundreds of times a minute. And firms despise them for the exact same reason they hate manual scalpers, but magnified by 1,000. A lot of HFT bots rely on a concept called latency arbitrage.
Arbitrage meaning exploiting a price difference.
Exactly. The bot essentially subscribes to an ultra-fast institutional data feed like an expensive direct fix API from a prime broker. But it executes its trades on the prop firm's slower retail server. Because of the physical server locations and the software routing, the prop firm's price might be lagging the real institutional price by, say, 200 milliseconds.
Which is barely a blink.
But for a computer, 200 milliseconds is an eternity. The bot sees the price spike on the fast feed, knows exactly where the market is going, and then buys it on the prop firm's slower feed before the firm has even updated their price.
Oh, wow. So they're basically predicting the past, like half a second in the past?
Right. They are executing risk-free trades because they already know the outcome. And on a demo evaluation account, it looks like you are an absolute genius printing money. Your equity curve goes straight up. But it is completely fake. It would never work in a real live market because the real market wouldn't give you those fills. So if you run an HFT bot or a grid trading bot or a martingale bot...
Wait, I've heard that term. What exactly is a martingale strategy?
It's a sizing strategy where every time you lose a trade, you double your position size on the next one. So if you lose $100, your next trade risks 200. If you lose that, you risk 400. The whole logic is that when you finally hit a winning trade, the outsized win covers all the previous sequential losses.
This sounds like a remarkably fast way to lose everything you own.
It is. It's essentially roulette. It's casino gambling. You hit a 6-trade losing streak and your account is completely obliterated. And prop firms will auto-fail you if their software detects that specific sizing pattern. So if you run any kind of automated system, you have to explicitly check the firm's EA approval list. You can't just assume your bot is fine.
And I'm guessing the software platform itself matters too, like where you actually install the bot.
Huge difference. In the retail space, you've primarily got MT4 and MT5, the MetaTrader platforms. A lot of retail traders still cling to MT4 because it's what they learned on 10 years ago. It's comfortable, it's familiar.
Sure.
But if you're serious about this, especially if you're running complex algorithmic backtesting, or you want to trade asset classes other than just pure Forex like crypto or commodities or indices, MT5 is just mechanically superior.
In what way? Like visually?
No, under the hood. MT4 is 32-bit. MT5 is 64-bit. MT5 has vastly better order routing, deeper market depth visibility. But mainly, the backtesting engine is so much faster and more accurate. MT5 supports multi-threading, so if you're trying to simulate 3 years of tick-by-tick data to see if your strategy survives a black swan event, MT4 might literally crash your computer or take a week to process it. MT5 handles it cleanly, and frankly, a lot of the newer, more legitimate prop firms are pushing everyone toward MT5 for CTrader anyway to phase out the old MT4 exploits.
Okay, so let's put this all together. Let's say I've done the homework. I know I'm a swing trader, so I found a firm with a static drawdown. I've mapped my historical worst day to make sure I'm sitting comfortably at that 40-60% sweet spot, giving myself a wide lane. I'm actively avoiding the news blackout windows, and I'm not using a banned martingale robot. Am I finally ready to buy the challenge?
Almost. But there is one final test. I call it the ultimate reality check. And the crazy thing is, literally nobody wants to do it.
Let me guess. Because it's boring and requires patience.
Because it takes a full month. You need to run a what-if analysis. You take your prospective prop firm's exact specific rule set, and you simulate your last 30 days of historical trading against it. You go back through your journal and say, okay, on the 14th, would this trade have clipped a news window? On the 22nd, would this drawdown have hit their trailing stop? But even better than that, you go open a free demo account somewhere, set the balance to the exact challenge size you want to buy, and you practice trading live for 30 days while strictly enforcing the firm's rules on yourself.
Oh, I see. You essentially act as your own risk desk. You manually enforce the daily loss limit, the news blackouts, the hold times, everything.
Everything. If you slip up, if you hold a trade 10 seconds into a CPI blackout, you consider the demo failed. You reset it and start completely over. The internal data across the industry shows that practicing for 30 days on a rule-restricted demo account can actually double your pass rates when you finally buy the real challenge. Double.
But nobody wants to do it because everyone in this space is hooked on the instant funding dopamine.
Yes. Exactly. They have $50 burning a hole in their pocket. They watch some lifestyle trading video on YouTube on a Friday night. They get totally hyped up. And by Monday morning, they are already 3% into drawdown on a challenge they barely comprehend. It's tragic, honestly, because it is so avoidable.
Okay, so looking at all this, we've covered a massive amount of ground here. And I'm realizing, as an outsider, that the evaluation phase isn't actually a test of your trading strategy at all. It's a test of your self-awareness. Like, do you actually know what your own numbers look like when things go wrong?
Yeah, I mean, yeah, that's exactly what it is. It's a forced audit of your discipline and your data before they even consider handing you capital.
So if we're synthesizing this for the listeners, and honestly for me too before I ever open an account, I think the biggest takeaway here is to stop buying challenges based purely on the entry price. The cheapest challenge is the one you don't have to buy twice because you blew it on a technicality. You have to buy based on the rule matrix. Specifically, figuring out if your style is going to get choked out by a trailing drawdown.
Well, yeah, the drawdown type is critical. But the second major piece is just knowing your math. You have to know your exact historical worst day percentage before you ever click buy. If you don't know what your worst day looks like, if you haven't tracked it, you have zero business paying for an evaluation.
Because you're just guessing where the guardrail is while driving a truck blindfolded.
Pretty much. And, you know, just to leave you guys with something to chew on, even if you pass, even if you do the math, find the perfect firm, pass the evaluation, and get funded, your job still isn't done. You should be actively reevaluating your prop firm every 6 to 12 months.
Wait, why? If you're funded and you're making payouts, why rock the boat? You made it.
Because the firm that got you funded might be the exact wrong firm to scale your capital with. As your account balance gets bigger, your psychological risk tolerance changes. Your lot sizes get heavier, which means liquidity matters more. And suddenly those slippage rules or their maximum payout frequency limits start bottlenecking your growth. A firm that is great for a 50K account might be terrible for a 500K account. But honestly, scaling infrastructure is a whole other mess. We would need a full hour just to unpack how scaling plans work.
Well, good thing we do this every week.
Ah.
We'll get into scaling and payout limits on the next deep dive, which sounds like an entirely different minefield.
Yeah, we'll definitely dive into that next week. Thanks for hanging out and listening, guys. Catch you on the next one.
See ya.